Hello dear learners, welcome to the second video In this video, we will discuss institutional sources of agricultural finance. As we discussed in the last video, farmers require finance for various agricultural activities such as purchasing seeds, fertilizers, machinery, irrigation facilities, etc. To sustain and improve agricultural productivity, timely access of finance is essential. Agricultural finance refers to the credit and financial services available to farmers for meeting their short-term and long-term financial needs. It helps in modernizing farming techniques, increasing crop yield, and ensuring food security. The availability of sufficient and affordable credit enables farmers to invest in better technology, purchase quality equipments, and manage risks more effectively. The financial requirements of farmers are met through various sources which can broadly categorized into institutional and non-institutional sources. Institutional sources include commercial banks, cooperative banks, and regional rural banks, which offers loans at regulated interest rates. Non-institutional finance or non-institutional sources include moneylenders, landlords, and commission agents who often charge exorbitant interest rates and exploit farmers. In this lecture, we will discuss institutional credit. Institutional credit refers to financial assistance provided by government-regulated financial institutions to the farmers. It is crucial because it ensures fair lending practices, reduces exploitation by moneylenders, and promotes sustainable agricultural development. There are three primary sources of institutional agricultural credit. They are commercial banks, cooperative banks, and regional rural banks. Let us first discuss the role of commercial banks in agricultural finance. Initially, the role of commercial banks was not very active in promoting rural credit. That is, after independence of the country, the commercial banks were reluctant to extend credit to the agriculture or rural sector. However, after nationalization of major commercial banks that started in 1969, the commercial bank started extending their rural branches and began directly financing the farmers. The number of rural branches of commercial bank increased from less than 25% of the total branches in 1969 to about 34.82% of the total bank branches in March 2022. Commercial banks offer various types of loans to the farmers. These may be classified as number 1, short-term credit or short-term finance. So farmers need short-term finance for meeting their working capital expenses like purchasing of fertilizers, seeds, pesticides, etc. Commercial banks provide credit to the farmers for purchase of such agricultural requirements. The next is medium and long-term finance. Commercial banks provide medium-term credit to the farmers but do not encourage the long-term credit. Money borrowed under this is usually used to purchase cattle, equipments, and improvement of land. In recent years, however, banks have become liberal and therefore have widened the scope of medium-term lending. Third category of credit provided by commercial banks to the farmers is direct finance. Direct finance is meant for expenditure on purchasing pump sets, tractors, and other agricultural machinery, construction of wells, bore wells, and tube wells, purchase of ploughing animals, purchase and development of land, and for many other activities. The fourth category of credit provided by commercial banks to farmers is indirect finance. Indirect finance refers to provision of finance to those organizations which are directly or indirectly involved with the agricultural sector. For example, cooperative societies are provided with funds to enable them function more effectively. Commercial banks also subscribe to the debentures of central land development banks besides extending loans to them. Indirect finance is provided to Food Corporation of India, the state government and other agencies for procurement, storage and distribution of food grains, which would then benefit farmers who are engaged in producing food grains. The next institutional arrangement for agricultural finance is lead bank scheme. The lead bank scheme, in short we call LBS, is a program that was introduced by the Reserve Bank of India in the year 1969. The objective of this scheme is to improve the flow of credit to priority sectors and promote the development of rural areas. The lead bank scheme aimed to establish a lead bank in every district of India. The lead bank would coordinate with other banks and financial institutions in the area. Under this scheme, launched by RBI, an individual commercial bank is made responsible for coordinating the efforts of all credit institutions in the allotted district to increase the flow of credit to the agriculture, MSME and other economic activities, with the district being the basic unit in terms of geographical area. The banks were expected to prepare district credit plan, that is DCP, in terms of both physical and financial targets for the overall development of a district through the coordinating efforts of all the three institutional financing agencies, that is the branches of commercial banks, regional rural banks and cooperative banks. The next institutional source of credit for agriculture is cooperative banks. A cooperative bank is a financial institution that is owned and operated by its members. They are based on the principle of cooperation, mutual aid and shared ownership. Following is the structure of cooperative banks in India. So in India we have got two types of cooperative credit institution. One is the agricultural credit institution, another is non-agricultural credit institution. So this agricultural credit institution can again be divided into two types. One is short-term credit institution, another is long-term credit institutions. So there are certain cooperative institutions which provide short-term credit to the agriculture sector or in the rural areas, and there are certain institutions which provide long-term credit to the farmers or in the rural areas. So again, short-term credit institution can be of three types. The first one is state cooperative institution, the second one is central cooperative banks, and the third one is primary agricultural credit societies, that is PACS. So let us discuss the short-term credit institutions, since these are the most popular form of cooperative banks operating in India. So number one is the state cooperative banks. So state cooperative banks are the apex of the cooperative credit structure. They act as a link between the central cooperative banks and the National Bank for Agriculture and Rural Development, that is NABARD. Then comes the central cooperative banks. Central cooperative banks function at the district level and provide a link between primary societies and the state cooperative banks. The primary societies borrow money from the state cooperatives through central cooperatives. The primary credit societies are at the base level or at the ground level, that is at the village level. They provide short and medium term credit to the farmers. Besides credit, they also help farmers by supplying seeds, fertilizers, agricultural equipment, marketing, farm produce, etc. To combine other services along with credit, Farmers Service Society, that is FSS, were established. On the recommendation of the study team appointed by the Government of India in the year 1971, large-sized Adivasi multi-purpose cooperative societies, that is LAMPS, were organized in the Adivasi and tribal areas. LAMPS provided variety of services from credit to marketing under one single roof. So, these are the cooperative institutions found in India which provides short-term credit to the farmers and villagers. There are cooperative institutions which provides long-term credits also. For long-term credit, land development banks are established. They work at two levels. At the district level, there are primary land development banks, and at state levels, there are state land development banks. Loans from the land development banks are for a period of 10 to 15 years, and at times they are extended for up to 20 years. Though cooperative banks play an important role in disseminating rural credit, it faces several challenges, including financial constraints such as limited capital base, high non-performing asset, and dependence on government support. Structural inefficiencies, weak management, political interference, and outdated technology further hinder their operations. Loan recovery remains a major issue due to poor repayment culture, lack of proper risk assessment, and farmers' vulnerability to crop failures and market fluctuations. Additionally, regulatory challenges arise from dual supervision by the RBI and state governments, leading to bureaucratic delays, limited outreach, low financial literacy among farmers, and competition from commercial banks and microfinance institutions further weaken their effectiveness. To enhance their role in rural finance, cooperative banks need better financial management, governance reform, digital adoption, and improved risk assessment strategies. The next institutional source of credit for agriculture is Regional Rural Bank, or RRBs. Regional rural banks were established in India on October 2nd, 1975, under the provision of the Regional Rural Banks Act of 1976. The primary objective behind the creation of RRB was to provide financial services to the rural and agriculture sectors, particularly for people who had limited access to formal banking. They were aimed at improving rural development, providing credit to small farmers, artisans, and rural businesses, and boosting economic activities in rural areas. In 2005, the government initiated the merger of RRBs to strengthen their capital base and enhance their outreach. As a result, the number of RRBs was reduced from 196 in 2005 to 56 by 2016. Further, consolidations brought the total down to 43 by 2020, improving their efficiency and financial stability. In November 2024, the Indian government proposed a significant consolidation plan to merge the existing 43 RRBs into 28 entities. This initiative aims to create one RRBs per state, thus streamlining operations and reducing administrative cost. Of the total loans extended by RRBs, about 46% goes to agriculture sector. About 90% of loans are extended to the priority sector. Of the total loans, about 79% is extended to weaker sections of the society. RRBs plays a significant role in extending microcredit. They account for 30% of the self-help group accounts and 26% of the loan amount. About 92% of the branches of RRBs are in rural and semi-urban areas. Though RRBs have 14% of total bank branches in the country, their share in total number of rural branches is around 29%. Many RRBs have branches in remote areas and they are providing financial services to vulnerable section of the society. Despite their importance, RRBs encountered several challenges. To point out few of them, number one is political interference. So while disbursing loan, they often influenced by political factors rather than genuine financial assessments. Due to low repayment rates, RRBs face financial constraints, limiting their lending capacity. Again, their operational flexibility is sometimes limited by the stringent government regulations or sometimes by the undue interference from the sponsoring banks, which make them less competitive than the other banks in the system. Then again, their capital base is very weak. I mean, it's not like strong as much as the other banking institution. Many RRBs struggle with financial sustainability due to insufficiency of capital. So let us discuss the role of NABARD in rural finance. NABARD, that is the National Bank for Agriculture and Rural Development, plays a crucial role in strengthening rural finance in India. Established in the year 1982, NABARD is the apex financial institution responsible for facilitating credit flow for agriculture, rural development and allied sectors. It works to ensure sustainable rural growth by providing financial support, policy guidance and capacity building initiatives. NABARD provides financial assistance to rural areas through refinancing, direct lending and development programs. It acts as an intermediary between the government, financial institutions and rural borrowers to ensure to smooth flow of credit for agriculture and rural development. Now, NABARD does not directly lend to individual farmers or rural entrepreneurs. Instead, it refinances the financial institutions such as regional rural banks, cooperative banks, that is at all levels, state cooperative banks, district central cooperative banks and primary agricultural credit societies. Then the NABARD refinances the commercial banks. It also refinances the microfinance institutions operating in the country. Through refinancing, NABARD supplies low-cost funds to these institutions, enabling them to offer affordable loans to farmers and rural businessmen. Direct finance provided by NABARD are like state governments for rural development projects such as road, irrigation, warehouses and rural electrification. Besides providing indirect finance or refinance, NABARD also provides direct lending to state government and rural infrastructure projects. While NABARD primarily works through intermediaries, it also directly finances state governments for many rural development projects such as road, irrigation, warehouses and rural electrification. It also provides direct finance to state-owned corporations and enterprises involved in agricultural infrastructure. Then the NABARD also provides direct finance to self-help groups and joint liability groups for microfinance initiative. Besides providing direct and indirect finance, NABARD also manages and funds some major schemes. Some of such schemes are: number one, the Rural Infrastructure Development Fund, that is RIDF. Under this fund, NABARD provides long-term financing to state governments for projects like irrigation, rural road and cold storage. The next one is Kisan Credit Card Support. Under this, NABARD supports KCC implementation by funding banks, enabling farmers to access short-term credit for purchasing seeds, fertilizers and other inputs. This scheme was introduced by NABARD in 1998-99 to facilitate access to credit for cooperative banks, commercial banks and RRBs. The next one is Self-Help Group Bank Linkage Program. Under this scheme, NABARD promotes microfinance and financial inclusion by linking SHGs with banks, providing small loans without collateral. Then, Long-Term Irrigation Fund. Under this scheme, NABARD supplies finance for large-scale irrigation projects to improve water availability for agriculture. Next, the Warehouse Infrastructure Fund. Under this, NABARD provides funding for warehousing, cold storage and rural godowns to reduce post-harvest losses. So these are some schemes or funds which NABARD facilitate for promotion of agriculture and rural areas. Now we discuss various sources of finance for agriculture, that is institutional finance for agriculture. Now though there are various institutions providing institutional finance to the farmers or in the rural areas, these institutions suffers from various limitations. So let us discuss those limitations. So number one is lengthy formalities. So while applying for a loan to the formal source of finance, that is to a bank, the farmers need to follow a lengthy procedure for obtaining credit from an organized source. So this keeps away a vast number of farmers from taking a loan. Also, going through official formalities for obtaining loans from institutional sources become difficult for poorly educated farmers. The next is need of collateral. So as we all know, when we go for a loan or when we approach a formal financial institution for a loan, they ask for collateral. So providing collateral as a measure of security against the amount of loan sanctioned become difficult when a farmer neither owns the land nor possesses proper ownership records of that land or any other property. So it becomes very difficult for farmers to provide a collateral to obtain a loan. Then majority of the banks provide loans to farmers for productive purpose only, that is only for farming activities. However, at times farmers are also in need of funds for their personal consumptions like marriage of children, sickness expenditures, etc. So in that case they have no other option but to resort to taking out loans from private moneylenders for such unproductive personal consumption expenditures. The next problem is political interference, that is loans are disbursed as directed by political leaders even to credit worthless borrowers, resulting in a large number of bad debts. Then there is corruption. So financial institutions lending agricultural finance do not function transparently. Bribe taken by banking professionals for sanctioning loans to the borrowers is a problem in the system. So this was all about institutional source of agricultural finance in India. In this video, we had discussed various sources of institutional agricultural finance. Thank you for watching this video. Thank you.